Mic's on, we're good? Can you hear me okay? Okay, good. If it's all right, with your permission, I'll do my presentation in English. Si je parlais français, je ne serais peut-être jamais invité à Quebec. So, in English, if okay? So thank you for having me very much. All right. Briefly, before I begin, I will give a brief presentation today, but maybe a few highlights. So we are an ad technology platform based in Toronto, also with offices in Miami and New York, but also Mexico City and Barcelona. A few highlights about us. Our last fully reported year was $126 million in revenue. Our current share price floats between, about at $2 and $2.50 the last 20 days. That's up considerably over the last 8 or 9 months. We have 51 million shares outstanding, so market cap of roughly $126 million. What might be of interest to you is we basically have no debt, and we have $50+ million on the balance sheet. Just an FSI, and about 23% of the stock is currently owned by insiders. So, with your permission, I'll move forward. Disclaimer and forward-looking statements. If my CFO was here right now, he asked me to make sure that you read that, so we're good. We'll call it even. Okay, so who we are. What we do is we're a large-scale proprietary ad technology platform that takes the demand of advertisers who want to put their ads on the internet or on your mobile phone or in a podcast, and they marry that demand with the supply from publishers. So demand would be Procter & Gamble or Toyota. Supply would be ESPN, CNN, Fox, for example. We've been in the business for about 15 years. Our entire platform, end-to-end, is built in-house with proprietary technology. We've been doing machine learning and AI for approximately 15 years. So we're well-positioned sort of for future growth. We play in a space that has a total addressable market in the US alone of about $300 billion. So it's a very large space. And all of global ad technology advertising is essentially split into 4 buckets that are all approximately the same size. They're all about 25%. The first, and the one that we play in, is what's called the open web or the open internet. This is the ability to marry demand and supply for advertising across a variety of internet properties and channels. The other 3 are called walled gardens or proprietary solutions. So that is all the advertising simply inside Meta, properties being Facebook, WhatsApp, Instagram, etc. Everything that is completely end-to-end owned by Google would be another walled garden. And there are then a collection of very large-scale super brands that make up the third, Amazon DSP being one of the larger ones, but you can also think of TikTok, for example, as another walled garden. So the $300 billion marketplace is sort of divided into those 4 buckets. We have historically grown up in the open internet, and we've got a nice position there. We've developed a very good reputation. We have 3 solutions that we offer our customers, which are primarily advertisers, mostly advertisers. One is called a managed services solution. So as advertisers want to place their advertising campaigns over the internet, we, through technology and also expertise, optimize those campaigns. We work with ad agencies to then get the best return on that marketing dollar for those advertisers. We also have a self-service product. So in other words, the brands of the customers of those agencies can do things on their own. And then we also have a solution that supports the publishers on the bottom end of that first graphic. That sort of essentially enhances the supply side of the advertising demand and supply marketplace. On the whole, about 50% of our revenue comes from managed services. A little more than 25% comes from self-service, and exchange service makes up the balance. They have a different margin profile. Managed services is a roughly 50% gross margin. The others, as you can see, range roughly at about 35%. We also have a very good reputation in our space. We're well known by agencies. We're very well positioned. We're widely regarded in the space as very smart, very good at expertise, built a really good core foundational basis of a business. Again, about last reported full year, about $126 million. That's really the very basics. I would now like to sort of turn towards, I think, the reason why you might be here, or maybe the reason why I'm here. And I think this is where the story maybe gets a little bit more interesting. Are we good? And everybody's good? Okay. So we built a nice book of business, primarily selling only managed services, that first bucket. We built about $100+ million business with a great gross margin, selling managed services. And it was a great stock to own if you owned it at the time on the TSX. In 2020, though, we went through a transition. The market was changing. There's some challenges. You might have heard of a few things, right? But generally on the whole, we made, as a company, a very stark directional change. What we said is that managed services was dead, and that the future lied solely in self-service. Self-service would give the company certain benefits. One, access to a much wider array of customers. Advertisers loved managed services. Self-service would be beloved by brands, and so in theory you could position to a larger market. Even though it had an inferior margin profile, the stickiness would be better. So the promise of better cash flows over time was part of the promise of transitioning to the self-service solution. Now, this message was very difficult for customers to hear, staff to hear, and quite frankly, yourselves as investors to hear. And as you see on the left, and it doesn't really show up on the contrast here, but there is a blue bar at the top that's very flat. That's the revenue over 3 years. So you can pretty much deduce it wasn't the best 3 years. And barely visible, but the light colored line on the bottom, that's the EBITDA. Again, not an overly compelling story. And if you look on the right side, you'll see a green line that has a huge spike and then goes down. Well, that was our share price. And you can pretty much peg when the transition was announced to the marketplace. Right? So hopefully now I have your attention. Are we good? All right, cool. All right, so let me move forward a little bit. Wow, I really need a tan. All right. In April 2024, management change was initiated voluntarily. The founding CEO stepped aside. A search was conducted, and I was hired as CEO April 15th, 2024. I have since made a couple of changes on the management team, and if you're okay, I'll highlight just 2 of them. One of the problems I saw in the business was I saw that self-service was actually growing nicely, but because managed services was declining, because we were walking away from managed services, we were really ending up at the same spot. And I didn't really like the way that the company was marketing itself, its brand, or self-service. And as a result, brought in new leadership to take over marketing. Bridget's background she comes from agencies and she's run brands, so our 2 customer pools. I've also worked with her in the past and she was exceptional. We've also brought in a new head of revenue in the upper right-hand corner. Liz Ritzkoven comes out of the greater New York City area, 25 years of experience in advertising sales, ad tech sales. She's worked for some big names, Bazaar Voice, Time Warner, Yahoo. You've probably heard of a few of those, AdSquare. So she comes with some really big names and she's had a really good track record. And so she took over as our Chief Revenue Officer in August of this year. I myself, my background, I never really intended it this way, but the street sees me as somebody who does turnarounds. So my last 2 times out as a CEO, 2 times ago, it was a top-line turnaround. It was a $120 million SaaS technology business, so same size as Illumin, different marketplace, but same size. Based here in Canada, we were doing $165 million in business and making no money and weren't really growing anywhere. And 3 years later, we did $1 billion in top line and 28% EBITDA margin. So it was a big turnaround in a hurry. It was a top line turnaround. I used some top line strategies to really drive us. The last time out as CEO, so the time between that time and my current role here at Illumin, was a bottom line turnaround. Again, a $100 million retail and e-commerce business based in Western Canada. It was very flat at $100 million in sales a year for 3 years, but the problem was it was hemorrhaging money. 2 years prior to a management change, it lost $20 million on $100 million. 1 year before a management change, it lost $28 million on $100 million. And the year that I was hired, it was tracking to lose $48 million on $100 million. To which I joked, wow, we are really getting good at this. I actually didn't even think, I'm like, hang on a sec, you're talking net or like gross margin? Like, we're really getting good at losing money. This is the Olympics. We're doing good. Gentleman has a question. The top or bottom line, or both? The top line turnaround was a company called P&I Networks, which used to be an ultra microcap company that was valued at $7 million, and it was acquired 3 years later for more than $100 million. And then the bottom line turnaround was a company that I had to take private to essentially rescue and turn it around to take out the public company costs, and it was acquired by private equity. And the name of the firm was Spud, which is an online grocery store based in Vancouver. So, yes, sir.
And what's your background?
I was CEO in both those roles, and CEO here, and then prior to that, I was in technology sales, and prior to that, I was an intelligence officer, and prior to that, I was a combat veteran. I served 5 years forward deployed. We're good? Sorry, I'm used to talking to a wide audience of team members, less investors, so I always check in. I apologize. All right, the management team is supported by a seasoned board. A couple names I will call out just in the interest of time to move forward. Sheldon Pollock is our chair. He's been involved in the company. He's a major investor. You may know him from some great exits, including Onyx Core. He's currently deeply involved in e-gaming. He's a big owner and chair of a microcap company based in Toronto called OV2, Overactive Media. And then Tal Hayek, who is the founding CEO, is no longer operational on the executive, but he does retain non-executive vice chairman role on the board of directors. So some of you may have met him if you knew the stock previously. So what have we done in a short period of time as a management team? Well, first and foremost, we went back into our customers and we said, managed services we think is really valuable to you. No matter how hard we've tried to fire you, you still stick with us. And we think that managed services is valuable too. So the first thing we did was we wanted to stem the losses on managed services. Self-service may replace managed over time. The thesis on self is actually quite sound. But the difference is I'm letting the market tell us that. And the market is telling us that they still have a very strong interest in managed. We don't necessarily see demand going away. In the first quarter, we stopped the bleed. In the second quarter, we flattened out. And in the third quarter, we actually grew 3%, which is only a small number, but after 3 years of essentially a 60% decline, getting 3% or 24% sequentially, I take as a pretty big win so far. So that was cool. We like this because the gross margin is great. Another thing we did is we start to reposition self for better success. Self was growing, and it's good and it's popular, but it has some stickiness issues. I want to see the product better. So we don't ratchet up our expenses. We actually keep them the same as opposed to bringing them down, so we're not realizing full leverage yet. But what I really like about self is year on year, we're now up 100% on 9 months reported, which is great. The growth has really been quite impressive. We're seeing a lot of new customers come into this space. We changed how we're selling last quarter, and the thing I really like is the average spend per customer went up significantly. And that, I think, is where we're starting to see some really great seeds of future growth. Third thing is we had that third bucket, if you remember from my first slide, exchange services, where we work with the publishers. This was really a nascent side of the business. And I asked a bunch of questions. Well, hang on a sec. It's still 20-some% of our sales. Why is it so neglected? So just being honest. And so we didn't put a lot of effort into exchange services yet, this third piece, but we got a lot of inbound demand over the last quarter or so. And so we have seen a nice sort of steady opportunistic rise in exchange services. And we've also seen some really smart decisions in the management team around really protecting our expenses and really starting to bring those down. We delisted off at NASDAQ. My decision on that was simple. This is just an ego play. We're too small. It's not important to be on NASDAQ. We can be over the counter in the US, but TSX is our board. That's where we're at. We're a Canadian tech company, so that's where we're at. So net result, if we look at the 9 months of fiscal year 24 that we've reported so far, we've gone from a negative, the actual revenue numbers aren't showing up, but basically we've gone from a -6 in Q1, -12 revenue comp in Q2, and then a 23% comp in a single quarter. So far, so good. We're beating the marketplace. Our gross margin also came through pretty good, very consistent, 46, 48, 47. On the EBITDA side, and this is the big turnaround, and unfortunately my grades aren't showing up, but in the Q1, which you can't see at all, that big white space on your left, we lost like 1.8 million in EBITDA, and so we broke even in Q1 this year. If you look at last year, we lost a ton of money in EBITDA in Q2. We came out at +11, and this last quarter we're up 200% year on year in EBITDA. In fact, we did more EBITDA in Q3 than we did all of last year combined. So we're starting to get some good momentum, and as CEO, I'm interested in this story. It's starting to show up in the stock. I started April 15th. The share price was give or take $1.50. 2 days ago we were $2.50. Now we're $2.35, something like that. So thank you to Rivemont for buying all those shares. I don't. So going forward, let me put our business in context, and then I'll sort of wrap up, and then happy to take any Q&A. So our market is a great market to be in. It's a growth market. All the analysts typically say that it's growing at about 15% a year. There's a variety of reasons for that. But what this graph shows, and again, sort of bleached out here a bit, there's a variety of different channels that are growing. It's not just one story that's growing. We see display ads, which are the ads you see on the open internet. They're growing. We're seeing ads inside of podcasts and audiobooks growing. We see ads inside of video booming. And a big one is what's called CTV, connected TV. So as those huge advertising budgets that used to live in your linear TV, your connected cable TV, are now switching over to streaming services like Prime and Netflix and etc. And that space is really just, to be honest, is so big and it's just starting to take off. That alone makes me bullish on the future of the advertising space. I'm going to skip over this because it's whited out. So we see a huge shift in CTV. We've tweaked our platform in the last 90, 120 days. This is our growth already on CTV up till September. I'm not even reporting Q4 yet. We haven't reported our Q4 yet. So October, November, December, that's our big quarter. But I don't know. I like that story as a CEO. I think that's pretty cool. We made a series of tweaks and all of a sudden we're seeing a quantum increase in our CTV, that connected TV channel, and the advertising through us. I like that. I like that so much that as a team, we went out and did 3 deals in 4 months. We signed a partnership with NBC Universal, Disney, and Paramount, all really big names in the CTV space. It helps validate our brand to new customers. It gives us great audiences that our existing customers want to target. It's win, 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 win. So I like this story a lot. Another area that I like is display ads continue to grow. So we've done a lot of new deals that I can't quite tell you about yet that are going to help us sort of grow on the display side, but we're already starting to see a very consistent tick up beyond seasonality. And last but not least, we have a couple of really big strategic advantages. So I mentioned those 4 buckets earlier, right? So when you're an advertiser and you want to hit all these channels, you have to do 4 times the work, right? You work with the Meta tools to deploy your advertising dollars in Meta. You work with your Google to deploy your ad dollars with Google, Amazon, TikTok, and then also whoever you're using on the open web. Hopefully you're using us, or at least you will be in the future, right? Now, of the 4 buckets, the 3 big walled gardens, like they're all huge. I don't want to, I'm sure you've all heard of Meta, right? Okay, so they're all huge, but they're all slightly a little rough right now. They're not really getting the return back to advertisers, but the open web is the one that's come back to growing after a couple years of being flat. So we're in kind of the right quadrant. But most notably, because of the nature of our proprietary technology, we're the only ones that actually have partnerships and the ability to see inside a walled garden. And when an advertiser deploys their ad dollars with Meta, they get a pretty good return. But when they deploy the same ad dollars on Meta with our tools through our Meta partnership, we generate anywhere from a 15 to 40% ROI. That, in my opinion, is a very winning pitch for our salespeople. So again, my angle is, let's do that a few times. I think that that is quite interesting because now, not only are advertisers getting a much better ROI in the same channels that they're already experimenting with, but they're doing 1 times the work as opposed to, in theory, 4 times the work if we can really sort of expand this sort of the the space. So I think that this is a really interesting story. Net, what to sort of look from us fundamentally, we report our Q4 on March 14th, 2025. We are highly focused on driving the performance of our self-service solution. I think the thesis again around self is correct, but the execution was challenged. I'm seeing much better execution right now. I like the fact that self expands us from advertisers into a second market, which is brand. What I also like is advertisers also want self. They've come back to us and said, we're interested in self too, and we're a little surprised. Really? And he goes, yeah, because every time we add a new client, we have to add new staff, right? Cost goes up as revenue goes up, hopefully wider apart. These are great businesses. But when you use our self product, they don't necessarily need the same multiple of staff because the AI can do a lot of work for you. So as they add new clients, they only need to say add half as much of staff or a third as much of staff. So they're very interested in this prop. So all of a sudden self, its value proposition is starting to really expand. we want to look to hold on to and possibly improve managed. Right now we're seeing improvements in managed. Again, I've said maybe self will kill managed over time. I'm not seeing it right now. I am seeing, if anything, demand from both brands and agencies that they want the white glove service, they want the support, and they want it really across not just Q4, but any sort of major demand quarter where they want to have the best chances of success with their clients. We're going to remain opportunistic on exchange services. This is not an area that we've focused on for years. It's still 23% of our business. We're giving it a little bit of lifeblood. I like the growth I'm seeing. It's still early days. I don't have a pattern yet, so I'm curious. So one of the things to look for from us is there also a pattern on exchange services? From an investor point of view, I like this story because we're moving from one source of revenue to possibly replacing that 100% source with a second source, moving away from that whole dialogue to now having 1, 2, and 3 sources of revenue that all serve slightly different interlacing markets, but use the same back end. That, I think, is a very interesting story. You should also look for us to do more walled garden announcements and product announcements, and you look for us to stay committed to EBITDA and cash generation. I come from the school of turnarounds where it is never growth at all costs. I am focusing on growth for certain. This is a growth turnaround. But we want to do it with EBITDA generation. Otherwise, in the end, what are we all here for, right? To be honest, I actually want to move away from EBITDA. I'm highly focused on free cash flow. Last but not least, we have a great balance sheet. I open with that for a reason, right? I don't have any exigent debt that I have to be really tracking against. Also, the nature of our model is we only book the cost of sales when we get the order. So I also don't have a working capital challenge. So as we move from losing cash over the last 3 years to now generating cash, right? I want to be able to use that balance sheet effectively. I don't really interested in buying technology. We've got more technology than we know what to do with, but I am interested in buying sales. I think that there are lots of opportunities for take segments or market shares in a smart, earn-out positive kind of way. There's definitely opportunities in the space because people aren't refinancing. There's lots of spaces that offer just managed services that are competitors and don't have a self-service product. So if we came together, not only could we win their managed services, but in theory, we could convert them over to self as well. So I think lots of opportunities in the future. I covered a lot of ground in a short period of time. Hopefully I made it entertaining for you. Happy to answer any questions. Thank you very much. Sorry? Yes, sir.
I would like to understand you're moving from the managed to sell services.
Yes, sir.
What you moved from, is it a technology platform that you were offering internally? You were using your technology platform internally, moving to...
Correct. We would use our technology internally and we would layer staff or expertise on top of that technology, and we would really do all the work for the agency client and really give them a lot of support and service and insight into reporting and really sort of help them succeed with their customers.
Are you considered as a tech company?
Yes.
Okay. And is your development is already complete to the self-services? When you move, you probably fire people to hire tech people and all the transition.
Well, I'll give you a qualitative answer and a quantitative answer. My qualitative answer would be I want to see the self-service product mature in 3 areas. Simplicity of the user interface, because a self-service product by nature attracts a wider audience, a more democratic audience, and this is a complicated skill. So I want to make sure that the workflow is simple. 2, we have a lot of opportunity to leverage our 15 years of AI to really implement a lot more automation, shorten the time to complete a task, provide better insights into what maybe is the best way to correct your advertising campaigns, instantly take creative and turn it into similar or different forms of creative. So we want to introduce that, and we want to introduce a lot more automated reporting. Reporting and results is really, to be honest, that's the bread and butter of this entire business. So if we can generate, it's great that we can generate amazing results and amazing reporting, but the more I can automate that, then the more customer retention I should have. So that's the qualitative answer. The quantitative answer is we have a very manageable OpEx line right now, especially around technology and development. I think more aggressive investors say, like, time to take that down, like, let's really exploit the leverage. I need 2025 to ensure that that product is going to have the stickiness I sort of need to see. So right now we're not ratcheting. We're going up in revenue and we're holding on to our gross margin, but I'm not ratcheting up the expense, but I'm not also taking it down. I want to see that product mature a little bit longer, but I feel better. And then I will let the market sort of tell me that indicator. We have thousands of clients across several different industries, from automotive to healthcare. The revenue ranges quite wildly, and it's actually sort of based on spend performance. We have a consumption model, and spend can vary from literally $1,000 a month to $1 million a month. It's hard for me to give you an unweighted answer. If I just gave you an average, it would be meaningless to you. Yes, sir?
We mentioned agencies as a volume, but you also work directly with brands and companies. Like what type of clients do you have?
Agencies, we typically are represented by sort of mid and slightly upper market size advertising agencies that typically have anywhere from 50 to 250 employees and have marketing budgets per client that range from, $2 million to upwards of $200 million. It's quite a range, but the market sort of has like 4 or 5 big titans, a good group of upper middle group, and then a lot of independents who are trying to get up. We're in that upper middle group. No, that on managed services. Self-service attracts brands, so think about the brands that then hire those agencies to create demand. They use our they hire us for our technology and services. Yeah. And then the brands serve, they represent a variety of industries: healthcare, insurance, CPG, apparel, food, beverage, entertainment. It's again, like there's no industry that we don't have a good brand reputation in. Yes, sir.
You mentioned we're part of a lot of turnarounds.
Yes, sir.
What's the end goal?
For illumin? Well, right now, I don't have an end goal. My goal right now is to build a meaningful, good business. I want to see my immediate term end goal, which is by definition isn't my end goal, is I want to see great pattern, and that's the phrase I use, a pattern of being free cash flow positive. The company has a history of losses, so I want to correct that. And the company also has a history of over-promising on growth, which had a disaffecting experience on investors, as you saw by that earlier graph. So again, my whole IR message is I'm significantly proning towards under-promise, over-deliver. If you hear me make a promise, it's because you know I have a winning hand. I'm a lousy poker player. But I will not come out and say we are being disruptive. You saw what we're doing. We've made some solid decisions. We're seeing some good early results. To be honest, I just plowed into the executive team today, just before I came here, and say, okay, we got these 15 problems to solve. And so it's under-promise, over-deliver, over and over again.
And how does the cap people look?
Today, we don't need any financing, 23% insider ownership, $50 million in the bank. I think that if you look at where people are in at, I couldn't tell you the average, to be honest, because the share price at one point was $33, and I came in at $1.50. So I don't know if anybody was at that level when they came in, but I'm sure there was a ton of people at $2, $4, $6, $8, and $10, and they're currently at $2.30 and change. So.